All right, guys, welcome back. So we're going to talk one of the decisions that we have, which is, should I pay off my mortgage or should I invest the money? It's a hotly debated topic, and a lot of people have very, very strong opinions. I have my own personal preference, but that doesn't mean that you need to do what I would do, okay? Because we're all different. So I'm just going to talk through some of the considerations that you need to think about as you approach this decision so you can find out what's best for you. There is no right or wrong answer, okay? As much as some people would like you to think that there is, there's no right or wrong. It all is completely dependent on your goals, your own preferences, and what might happen with interest rates, what might happen with investment returns. Since a lot of that we don't have control over and can't influence really, there's no right answer. Somebody could be right or wrong just based on outside variables. So it's important that you find what fits best with you. So I'm going to walk through some of those. So the arguments for paying off the mortgage, okay, there are good reasons to do it. Number one, you get rid of a massive liability, right? Having a mortgage is still debt, and debt needs to be paid off or your home could be repossessed, right? And they could foreclose on you. And so liabilities and debts, they do carry an amount of risk, right? That's why they're called liabilities. So there is risk involved, okay? Another reason is cash flow. A mortgage payment, as we looked at ratios before, let's say it's around 26% of your take home or your gross income is what your mortgage payment is. If you get that paid off, all of a sudden that frees up 26%, a quarter of your income to put towards other things like supercharging investments. So some people like to pay off their house as soon as possible, and then they take all that money and all their mortgage payment and all the extra money they're putting at it, and then just start supercharging their investments. That's totally a way to go as well. But some people like to do that. Then they have no debt, and all their free cash flow can go towards investments. If they have a problem, they just stop investing, but they don't have liabilities that are hanging over their head. Okay. Some of the cons that are often talked about with paying off your mortgage early is that your interest rate is so low. You're paying, right now that it's in the threes. I've seen them in the twos. So 2, 3, 4%, you're paying to borrow money, and you can use your own cash to go get a higher rate of return in the market. So if you don't pay off the home early and you put that extra cash to work for you, then all of a sudden, and you're getting 8, 9%, then you're earning 9%, you're paying 4%, and your net is 5%. So overall, you're gaining 5%, right? That's kind of the common kind of rationale behind investing versus paying off your mortgage, which also can make a lot of sense. So which way do we go? Which way is the way for you? Well, number one, it's important to understand that investment returns are not guaranteed. I have two charts I'm going to show you really quick that illustrate this really, really well. So this is the first one. Okay, this shows the S&P 500, so the Standard & Poor's 500 index, top largest 500 companies in the US, and it shows its returns based on time frame. So on any given day, 56% of the time it's up and positive, 44% of the time it's negative. That's basically a coin flip, okay, on a daily basis. So the more short-term you look, the more volatile and unpredictable your returns are going to be. Nobody knows if next month we're going to be up or down. But as you start lengthening out the time that you're looking at, then you start to see this change. So over any given 1 year time period, 75% of the time, the market was positive, 24% of the time negative, okay? So now we're more than a quarter flip, more than a 50-50 coin flip, right? We're at 75% is positive. It's pretty good. Over any given 5-year period, the market, the S&P 500 was positive 87% of the time, negative 12% of the time. Over any given 10-year period, it was positive 94% of the time, negative 5% of the time, okay? And over any given 10-year period, it was positive 100% of the time and negative 0. So the longer that you leave your money invested, and I'm talking about the stock market here because this is the most easy to kind of relate. There's other investments that are not correlated with the stock market. Obviously, we'll talk about those later, but I'm just trying to set a baseline expectation here. So the longer that you leave your money invested, the less chance of you losing money over that period. So here's another chart that kind of illustrates a similar principle. So over a 1-year time period, these were the range of returns. In other words, you could have been up 54% or down 43%. And the periods of negative returns, 26%, kind of like we saw before. Over a 5-year time frame, the range of returns, you could be up 28% or down 12%. And the negative returns, right, 13%, like the other chart showed. Over a 10-year period, your range of returns -1, as low as -1 and as high as 20. And as you start moving here to 15 years and beyond, right, the range of returns all of a sudden are not negative any longer. They're positive. They're in the positive territory. And you can see that the floor raises and the ceiling lowers, okay? So in the really near term, high volatility, high possible return, low possible loss, or, low return. So as time goes on, this gets a little bit less volatile, and the range, right, the spread becomes more manageable. So why is this important? Well, if you're thinking about, this could be a mortgage, or it could also be another type of debt that has some interest rate, like an auto loan. If you have a 4% auto loan and you could pay it off, has a 3-year term. Well, if you decide to invest that money, right? Because you're like, oh, I can totally get more than 4% by investing it. Well, you have a 13% chance of losing money during that period. And the range of returns, you could get as high as 28, as low as 12. So if you end up earning 28% over that time period, then yeah, it was obviously worth it to invest versus pay off the debt. But if you got negative 12%, then all of a sudden you lost investment value and you still have your debt. So over a very short period of time, all of a sudden the rationale for not investing and paying off the debt makes sense. It kind of makes sense, right? So investment rates of return are not guaranteed, but paying off interest is guaranteed. If you pay off your 3% loan, then you have a guaranteed 3% rate of return on that money, right? You're saving a 3% cost versus earning a rate of investment return, okay? So you're essentially earning 3% on paying off that loan. That is guaranteed, and guaranteed rates of return are hard to come by. So investment returns are variable. The longer you plan to invest, the higher the likelihood of you earning a good return, a positive return that outweighs, paying off debt during that same time frame, okay? But it's still not guaranteed. There's still variability, and those are all the past. Future could be different. We don't know. So time horizon is really important. And then the other thing really to think about here is personal preference. I have as I've worked through a number of different couples and worked with them on these types of decisions, sometimes they choose to put down a low amount as a down payment on their house, take as big of a mortgage as possible, and then invest all that they can and just pay off their mortgage like normal. Others say, no, I don't want the debt. I don't want a mortgage. And so they're putting the bulk of their money into paying off their mortgage as fast as possible. There's no right or wrong there. It's all personal preference. And especially if you are, if you're a couple, you guys have to be on the same page there, and you have to come to an understanding. Sometimes that involves compromise. That's the way that it works in relationships. It's the same with money. Sometimes one person wants to pay it off, the other person wants to invest. Well, maybe you do half and half. You say, okay, well, we'll invest some money and we'll pay off the mortgage with this other money. So personal preference reigns supreme. Don't let anybody tell you one way or the other. You guys understand the considerations. You decide what makes the most sense for your situation. The only other thing that I will mention in this conversation is that when we do the numbers of investing over the long term versus paying off a mortgage, generally speaking, we're looking at that 30-year time frame. And so over that time frame, you are paying that percent in interest. But according to Rocket Mortgage, the average loan length is less than 10 years. So if you think through, how many people do you think actually finish their 30-year loan? It's not that many, right? Because you move, or also you refinance and start the clock over. So you might stay in the same house, but you might refinance, okay? So finishing out and actually paying off the 30-year loan, that's where all of a sudden you're paying that amount of interest over the 30 years. And if you invested over those same 30 years, you would have done better, right? But most people are not keeping that same mortgage for longer than 10 years. And so if you buy it and then refinance in 5 years, you start the clock over again. Then you move and you start the clock over again. And then you refinance again. You start the clock over again. And so you're perpetually stuck at the beginning of that mortgage, the amortization statement that we saw, and you're putting more and more money towards interest versus your principal. There's a reason why all the mortgage lenders want you to refinance. Yeah, there's low rates. You might save money monthly, but you're going to start the clock over, which means they get more interest again. Okay. So it's just one consideration there as you're thinking through this, but you got to find the right mix for you. And that is your assignment. Think through it, look at some numbers, and decide what makes the most sense for you and your situation. Okay. And we'll see you in the next video.
Keep choosing progress, one smart decision at a time.